Treasuries are heading higher today after a federal judge ruled against a key portion of the healthcare overhaul. Joe Balestrino is a fixed income strategist at Federated Investors in Pittsburgh. He's also a Bloomberg Best for global bond funds. The Federated Strategic Income Fund ranks in the top third percentile against its peers for the past 5 years. Joe, welcome back to Bloomberg. Always good to have you on.
Thanks, Mark. Good to be here again.
Joe, this ruling out of Virginia by this federal judge on part of the healthcare reform law. Talk to us about the effect that is having on the bond market today.
Yeah, I'm not sure it's having an effect on the bond market. We're just taking a breather. They always say you can't go one way, but we've been going one way on the bond side with yields, skyrocketing. At the margin, when you get those types of headlines, it would argue for, obviously a less constructive atmosphere, maybe less growth at the margin, so bond market friendly. But I don't think that's what's driving the market today.
But we are seeing Treasuries gaining today.
We are, which is a kind of a pleasant surprise. We haven't had that in the last 2 or 3 weeks.
Joe, the president's compromise with Republicans on the Bush tax cuts, did that have an effect on what we were seeing in Treasuries last week?
Very much so. We've had 2 major negatives for the Treasury market specifically. One, simply the data is better, and that's not debatable. From everything from manufacturing to retail sales to jobs, et cetera, is all pointing higher. And then the tax compromise simply says there's more money in people's pockets. Even if some of it gets spent, there's argument that it's another ½ a point on GDP for 2011. So everything's being priced accordingly, which is down on the bond side of things.
Well, where's the bond market's focus right now? Last week, the equity market liked what it heard regarding that compromise, but the bond market, not so much.
Well, the bond market, for logical reasons, did not like it. The reality is that we're going to put more money in everyone's pocket, and that was a surprise. There was an expectation that the Bush tax cuts would get extended. There was an expectation that unemployment benefits would get extended. The new information was the business tax credit, and more importantly, the 2% payroll tax cut. And that's for every working American. So that's a big deal. That's roughly $120 billion flowing, part of it into the economy next year.
Joe, you've put out a paper, and the title of it is Disregard the End of Bubble Talk. Why?
Well, we didn't think we were in a bubble. We still don't believe we were in a bubble. The economy, well, you had an unprecedented, at least in our lifetime, unprecedented financial crisis, the Great Recession, almost the Great Depression. So there's a reason why when nominal growth goes to 2 and 3%, the yields are supposed to fall accordingly, and they did, and now they're slowly mending and yields are going back up. So we don't think we were in a bubble, and then we wouldn't be surprised to see yields fall back down here after the euphoria is over. That's the political euphoria.
Well, you also talk about what you see as other forces at play, namely the Fed's second round of quantitative easing. How did that impact things?
Well, it impacted things because the Fed wanted to get us investors, all of us investors, out of the Treasury market into the higher risk asset classes. And so far, so good. High yield bonds are doing well. Corporate bonds are doing well. More importantly, stock market prices are doing very well. Oddly enough, the dollar is as well. That's kind of a counterintuitive impact. But the reality is the Fed wanted us to move into the other markets because they drove Treasury rates down. Treasury rates are obviously up, so I doubt that they're feeling too good about the impact on the bond market itself. There has to be a self-correcting mentality here. To the extent that yields keep going up, you've probably hurt yourself on the economic front.
Well, how much further might bond prices fall then?
I'd be surprised if they fall at all between now and year end. In fact, we would think they would go back up a little bit in price. But the reality is if the train has left the station, so to speak, if the economy is now on the mend, they can go up quite a bit over the next year. We just don't think the acceleration we've seen is warranted.
How might these swings in the bond market affect the overall economic recovery?
Well, it's a great point, because as we were just saying, to the extent that yields go up, we went from 2 3/4 to 3.30. It seems like in a heartbeat. We add another 50 basis points and get that 10-year up near 4%. We're going to be even more worried about the economic recovery, especially the housing component of it, which is still bumping along the bottom. So there is a self-correcting mechanism here. We don't think the Fed wants to see rates go up.
Joe, in our last minute, what's happening in places like Ireland and Greece throw a wrench into all of this?
Yes, very much so. We think there are two overriding now, albeit they are bigger, more intangible, nebulous concerns, but nonetheless, they are there. One is Europe at large, and Europe is a mess. It's far from over. There are many negative chapters to be written. Frankly, I think there's a restructuring to be written in Greece, in Ireland, if not Portugal, and hopefully not something bigger than that. And then you have the emerging economies that are tightening monetary policy, and the reality is monetary policy works.
All right, Joseph Balestrino, Federated Investors in Pittsburgh.